You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hi again. I'm Don McDonald. Over there is Tom Cock, and you have intelligently either tuned into or chosen to listen to Talking Real Money, the radio show / eventually podcast, where we try and make money one of the easier parts of your life to deal with as opposed to one of the harder parts of your life to deal with. And we hope that we can help you in any way possible with your call to us at 855-935-TALK, 855-935-8255. Now, while most folks in the financial services industry profess to have magical powers, incredible skill sets, the ability to predict the future, we don't. We don't.
By
Do
the
you know
way,
how to predict the future?
I don't. Even the great Warren Buffett has had trouble predicting the future the last 10 years. And he's told his wife just own an index fund. But go on.
Yeah. But we believe, and we believe this based on tons of academic evidence, that despite the fact that it seems like it's obvious at times, beating the market is not something anyone can consistently do.
I'd say even beyond that, I think even taking that one more step is knowing enough to either be in and out of the market at the right time, knowing enough to be in and out of a group of stocks at the right time. Say, well, why would you want to be in entertainment stocks right now? Psh,
Right.
they're done.
Right.
Nobody goes to
Right.
Orlando anymore.
And had I known in January of 2020 that Walt Disney World would shut down until probably the middle of summer, had I known that in advance, then yes, I could have sold stock in the Walt Disney Company. But I didn't know it. Nobody knew it. People who work for the Walt Disney Company didn't know it and didn't sell their stock. They didn't know people would stop going to movies.
Stop
in late
going
March
to
and
cruise
April.
ships.
Stop going on cruise ships. Stop going to restaurants. Stop staying in hotels. Nobody knew that because guess what? Nobody, except those who got lucky, sold before it happened. So we get the question all the time. Why do you suggest these boring index funds like Vanguard's Total World Stock Index, which, by the way, we suggest just because it's a simple way for someone to own the market?
And what you get when you own VT Wax is
Vanguard
about
Total World Stock Index.
9,000 securities, U.S., international, big, some a little bit of small, a little bit of value, not as much as we'd like you to have. But as Don said, you own it very simply, very inexpensively. So the reason that we recommend that rather than trying to say, well, today you don't want to own banks because they're going to have trouble with mortgages. They're going to have all kinds of whatever issue coming up. You don't want to be in the entertainment, right? You certainly didn't want to own oil a month ago, even though I noticed that crude had the number one return again this week, 2 weeks in a row. But because the reason you own all of them is we don't know what's coming next. We don't know which sector will profit from the economy reopening more than another. And the best approach that we can find is based on, as you said, Don, decades of research and decades of research from people we think you could trust. Academics, they don't care how you invest. They simply
Like
look at the
people who
markets.
won Nobel Prizes.
Yeah, they
folks.
just have said, here's what it looks like going back the best way. That's why We think you should be in index mutual funds, widely diversified. That's it.
And as human beings, we have a nasty psychological problem. We really do. We have a psychological problem. We look at today and we say to ourselves, oh, I knew that was going to happen. But you didn't know it was going to happen, because if you knew it was going to happen, you knew for a fact that the entertainment industry was going to go down. You knew that the cruise industry was going to go down, that restaurants were going to go down. You knew that. I knew that was going to happen. Then why didn't you short the stock?
And by the way, the other part of that is we have a tendency to believe that what's happening today will happen tomorrow, will happen Monday. It will recency bias is a problem as well.
So what if right now Disney's as low as it's going to go, for example? Do you know it isn't? Of course you don't. You have to own the market, because you can't do anything else. You don't know the future.
Tom and Don are talking real money.
These are extraordinary times, and you may be getting news you didn't want to hear. That is, your company wants you to retire sooner than you'd planned and take an early buyout. But how does that buyout fit into your retirement plan, and how do you pay for a lengthier retirement? Hi, this is Tom. Our company, Vestry, was created for times exactly like these. We exist to help our clients transition to retirement seamlessly and without worry. And during this health crisis, we do it all electronically with an unmatched level of service. Get a free virtual consultation now. Go to Vestory.com, Vestory.com, and click on Schedule an Appointment. Not only do we work to build your wealth, we manage your money to create a lifelong income stream without using expensive annuities. And let me make you a guarantee. The meeting is free, there is no obligation, and absolutely no high-pressure sales pitch. Visit Vestory.com, that's Vestory.com, click on Schedule an Appointment.
For your real life and real future, Tom and Don are talking real money.
Well, a respected newsman, who we will not name, actually is looking for ways to pick stocks and make money. And his latest pick is bidet stocks.
Yeah, which, I think it's all. I think honestly that bet is all wet, but that's just me.
Yeah, so. Well, I got to tell you, I can see ranchers down there on the plains going,
very popular in East Texas.
Hey, honey, I just got off a long trail ride, and I'm looking to hose off my nether regions.
Yeah,
there.
Lovely.
Y'all.
Thank you for that.
855-935-TALK is our phone number. 855-935-8255. What?
Good. No, it's a very good point. Because if you think you have some great idea.
Yeah, and people do.
Right. Well, that's easy. Okay, everybody. The minute you do that, the minute you have that idea, number one, there's probably somebody else who had the idea, probably. Number two, remember that about 90% of the trades that are made on Wall Street today are made by large institutions. Now, they spend millions of dollars, hundreds, a lot of money looking at all these companies to figure out what's going to happen.
Some hefty change there,
exactly,
partner.
Exactly.
Yeah. And they spend really
they have
money.
Decided that the price should be this based on all that information. Mm-hmm. It's what we call baked into the cake.
Yeah. In fact, I'm pretty sure that the minute this Wuhan virus started, when it started in China, somebody at some giant financial firm was looking around going, what could happen?
Oh, yeah.
And
there'll be somebody a year from now that made the right bet on all this. Hey, they made 500%. But it was somebody with
resources. It was somebody with resources that exceed yours, and somebody who could afford if they were wrong. You see, this is the key. Can you afford to be wrong in your prediction?
I'll go one step further. Do you need to beat the market? Remembering that markets have made you.
Good point.
I mean, if you go back almost 100 years now with the actual numbers, generally you've made close to double digits a year. Not every year,
right?
Not every month, but over time. So, do you need your money to compound faster than that to have a successful retirement, which is what most investing should be for. And in addition to that, you just mentioned something very critical. The people that can make those kind of bets, they can be wrong, right? Sure,
Right.
They can afford it. We know that they're wrong more than they're right, because there's
Right.
another more indication that the pension funds, which oftentimes use hedge funds, right, private equity, smart money.
I got a call. We got a call for the podcast last week from a guy in Chicago.
Yeah.
Whose pension, he works for the city.
Yeah.
Whose pension is heavily invested in hedge funds, and he was going, "How do I check on these?" And I go, "You can't.
You can't.
You
And
just
they
can't."
have a worst. Their track record. Well, you just remember they made a bet with Warren Buffett, the 5 hedge funds versus the S&P 500. They got crushed. Over time, they have not beaten the market. They are illiquid. They are more expensive. So if you think you're really smart, and maybe you are, number one, I would ask you to consider what rate of return you need on your money. Number two, I would say even the really smart, and Warren Buffett, article today at Market Watch saying it's all over for Buffett. He sold out of the airlines. He's made bad trades the last decade. There isn't anybody who's done this. I mean, the pension the numbers, by the way, are astounding. What do they just say? They're $4 trillion short of the $9 trillion they need to supply people, because they overpromised, because they undercollected, and because they underproduced. The last 20 years, had you just bought an 80-20 index portfolio, you made 5.7% a year. The pensions, which I think are managed about to an 80-20. I looked at the Washington State pension, 5.2% a year, 0.5% less per year with the really smart money, the really smart people managing the really smart money. I mean, this is the problem you face. So I love the fact that people have these great ideas, but I'm going to tamp down on your enthusiasm a little bit because they may not work out.
Yeah, and the hedge funds are an interesting exercise. When you study them, you can look at how hedge funds do in aggregate thanks to the Barclay Hedge Fund Index, and they try to track all of the hedge funds and
the
their
ones that
aggregate
report,
performance.
by the way. Yeah.
And what's interesting is that hedge funds do better than a globally diversified portfolio of stocks in a down market. But they do significantly worse in an up market. And here's what we miss as investors. We have it in our heads that the stock market is a zero-sum game.
Good point. That's a good point.
That there are as many bad days as there are good ones, that stocks go up as much as they go down. So if you protect yourself in the down markets and you do okay in the up markets, you're going to do well. That is not the case. Let me give you a great example. Let's go back to 2016. The stock market, the total global stock market, did about 9% in 2016.
Yep.
The hedge fund index gained 6% less.
Yep.
Pretty substantial amount less. About 25% less. Then in 2017, which was a great year for stocks, 24% for a global portfolio, they only gained 10. That is way less than half. Then in 2018, when the market as a whole, the global market, lost about 10%, they lost only about half.
Well, they are hedge funds. Remember where this whole thing started from? They were a hedge against stocks. That's what the purpose was.
But they're not working because they still lose you money in bad markets. The year to date through April for hedge funds is a negative 7%.
The best thing
so they didn't save you from a loss.
The best thing hedge funds ever did was create Billions, the television show.
That's right.
That's
Which
the
I have
best
not
outcome.
watched yet.
Yeah, I won't
because
tell you
I'm
anything
having
more.
a terrible time logging into Showtime.
Oh, okay.
Showtime.
But coming up with Bobby Axelrod and the rest of the cast of Billions, that's the most brilliant thing hedge funds have ever done. I'm sorry, it's the truth. That's the outcome. I'll make another bet with you because we won't be here. It's unlikely.
Yeah, you know,
unless you have your head frozen.
Yet, go ahead.
All right. 100 years from now, people will say, "What? They paid these guys 2% and 20% of the profits to do what?" No,
Yeah.
They won't be around. That will be the end of that.
I just want to use 2020. You've got hedge funds. They've returned negative 7% through April.
Yeah.
Okay.
That's good.
Now, is there another way you can hedge your bets against a falling stock market? What's the typical way most investors, poorer investors,
bonds?
What do we do?
Fixed income.
We use a balanced approach, right?
Right. Mm-hmm.
So let's say 60% stocks, 40% bonds. That's the Vanguard Balanced Index.
And how's that done?
Negative 5%.
There you go. And so you didn't have the excitement of being in a hedge fund.
Well, and in 2019, you made 22% when they only made 10.
There you go.
Hedge funds are just stupid. And why pensions own them? It's because of the buddy system. I know a buddy who runs a hedge fund, and he's really smart. His name's Bobby Axelrod. There, I got that in for you.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-8255. I'm Don McDonald. That's Tom Cock. This is Talking Real Money, the show that tries to make money easier to deal with. And I know I hate to burst your bubble. I do hate to burst your bubble. But you're not going to find any magic tricks. You're not going to find a manager who's going to beat the market for you. You're not going to win with a hedge fund. You're not going to win with some complex strategy. You're not going to find a portfolio or an investment that returns more than the market with less of the risk. You're dreaming. And you are dreaming, but you're dreaming a dream that Wall Street, that the insurance industry perpetuates to the tune of hundreds of millions of dollars in promotion and advertising. So it's hard
to get it right.
Go ahead.
It's not
hard to get it through your head.
Yeah, this is not something, we shouldn't blame you, the listener. In this case, it really is the industry, because the industry has suggested that stockbrokers, if you call your broker, I can guarantee this is Monday, call them up and say, hey, what's going to happen with the market? They'll say, oh, well, let me give you the update, blah, blah, blah. And they don't know, but they're going to act like they do, because this is what the industry has done for 100 years, is act like we know what's coming next. Your portfolio should be built with whatever's coming next. And that how you do that is exactly what you just said, Don, a minute ago. You hedge against potential losses by owning things like bonds. That's what
Which is the simple and cheap way to do it. That's the thing, is it doesn't cost you extra money to hedge your portfolio with some bonds, and you've gotten in the past. You have gotten a less volatile portfolio with better upside and better downside performance than you would have gotten with an expensive, professionally managed hedge fund charging you 2% per year.
Plus
20% of profits in the good years. Vanguard does the same thing. If you use VTWAX and VBTLX, the total bond index, you are doing the same kind. You're doing the same kind of balanced hedging, but you're doing it for, and it's better hedging, you're doing it for 8/100ths of 1%.
Except you're not investing in farmlands in North Dakota. You're not investing in timber in South America. And you're not investing in, I just read a piece, maybe if we get to it, we can, in rusting old ocean-going vessels that you're investing. No, this is a real story. People are investing in those in a private fund, and then they woke up one day and went, wow, our $89 million disappeared. Not there. Shocking. Must have gone to the bottom of the ocean.
855-935-TALK is our number. John, you're up. Welcome to Talking Real Money. Hi, John.
I have followed you guys for a couple of years. I've been to some of your seminars. I'm within probably 2 years of retiring. You guys used to recommend 3 funds in like a 60-40 split, and I'm close, but I noticed on your website you're down to 2 funds. Is there a reason for that?
Yes, there is. The reason is now you can own a globally diversified stock portfolio in one fund. It used to be you had to hold two. You had to hold a U.S. and an international. Vanguard very kindly rolled that into the Vanguard Total World Stock Index, VTWAX. That holds about 9,000 securities, globally diversified, very low cost. So the stock part goes in that, and then the bond part goes in the Vanguard Total Bond. And if you're going to do it on your own, we think that's about as good as you can get.
Okay, because I was in the total bond market, the total international stock, and the total stock market in the automobile shares.
And
you
that's
still
perfect
do it
too.
Yeah. Mm-hmm.
That's just as good. It's just if we can make it easier for people, then we look for a way to make it easier. And this is just easier. It's perfectly fine to have the three-fund solution. Just make sure you balance between U.S. and international and bonds as your portfolios adjust due to price, and you'll be fine long-term. 855-935-TALK is our phone number, 855-935-8255. If you are confused at all about anything financial, before you find yourself getting in trouble, you need to call us.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
Reality radio for a really great future. We're talking real money.
As if to illustrate your point earlier, Tom.
Yes.
Headline from Market Watch. Dud stock prices, bad industry bets, vast underperformance. It's the end of the Warren Buffett era.
That's the article I was referring to, which is free, by the way. You can go. Anybody can go read that. And Warren, in the article, said it again. I've told my wife, just go buy an index fund.
Yeah. The chairman of Berkshire Hathaway seems to prefer the S&P 500.
Yeah. Well,
what is wrong with him? Pure, utter mediocrity.
I'm going to say at 90, he's finally got clarity, not mediocrity. So
yeah, no kidding.
90 this year.
855-935. He's that old?
He's running still, and I think Munger is 95 or 96 or something. Jeez. Long time to be running a mutual fund or stock.
855-935. Talk is our phone number. Give us a call, 855-935-8255. And Carrie, you're up next. Welcome to the show.
Hello, Carrie.
Hi, thank you. Hey, I just had a quick question. You had talked about the Vanguard Total, I think it's Total World Index.
Yes.
Yep. Total World Stock Index.
Yes. Is there a similar one for Fidelity that you recommend? I hear you talking about both Vanguard and Fidelity.
The answer is no.
Yeah.
They don't have one, but hang on, Don's looking right now. I mean, they don't have one fund, I don't believe. I think you probably own two of them at Fidelity that would give you the total U.S. and the total international.
Yeah, there's a total. Okay. There's one called the Fidelity Total Market Index.
What's the ticker?
VSKAX.
V is in victory?
Uh-huh.
S.
Wait, was that right? F.
No.
I'm sorry.
I was going to say F. Fidelity. FSKAX.
Uh-huh.
That's.
And then there's a. Hold on. Then there's an international.
So, Carrie, that's FSKAX. That's the Fidelity Total U.S. market. And then the total international is FT, as in Tom, IHX. FTIHX, so that gives you the international exposure. So those are going to be a hair more expensive probably than the Fidelity, just a little bit. I don't know that they We'd have to dive into them. But, I mean, the reason that, and people have asked us, why you guys love Vanguard so much? Well, number one, they kick back huge amounts of money to us every month. So we have – no, I'm kidding. They don't do that. We've been waiting for that check. The reason is Vanguard has – the reason I'll say it for myself. They're the ones that have done this the longest. Everybody else has gotten into this game in the last decade because they realized, investors just want to buy index funds. They do it at very low cost. They manage these index funds very, very well, and they have a track record. So Fidelity is still, I would say, relatively new and doesn't spend as much time on indexing as Vanguard has. Don?
Wow, but their expense ratios. Holy moly. Do you know what the expense ratio is on the U.S. total market fund?
5 basis points.
No, go lower.
3.
Go lower.
2.
Go lower.
Is this one of their frees?
1.5 basis points.
Wow.
And 6 basis points for the international, which makes a 50-50 average of just right around
pretty close.
3.5.
So carry on that situation.
That's cheap.
That is very inexpensive. So our suggestion, if you're going to hold those two funds for your stock portfolio, would be put half in each one, because the world is about divided that way when it comes to the value of those companies, if you were, the market capitalization. So put 50% in each one of those.
Okay, thank you.
You're most welcome.
You're welcome.
Thank you for the call.
Thanks,
That's
Gary.
interesting. Yeah.
855-935-TALK. Fidelity is being very, very competitive.
They knew they got
off,
whooped for a long time, so they got to
off
come
the
back.
charts competitive. I'm not a big fan of their zero funds, though, because they're emulators.
Yeah.
They don't own the market, but it's still, they're fine either way. 855-935-TALK. You can call that number 24 hours a day, 7 days a week, or when we're live here. And we're getting close, but let's try. Suzanne, welcome to Talking Real Money.
Hi there. Thanks for taking my call. I'm an old timer, and I think I may have made a mistake that I'd like you to straighten out. Me and other listeners might benefit. When I started putting money into the market many decades ago, I started by using IRA accounts. And then I also put into what are called simply investment accounts.
Yes.
So there must be correct ones to use, or better ones to use going into IRA versus the investment accounts. And then as to when you would be taking any money out.
Yeah.
Here's
what we need to do, because Suzanne, what you're talking about are the baskets in which investments sit right now. What we need to do is dig down into what is actually in these two baskets, the investment account, which is probably a taxable account, and the IRA account. So if you have some information or can get it during the break, that would be great.
Tom and Don are talking real money.
Hi, I'm Don McDonald from Como's Talking Real Money. In the wake of this global health crisis, many businesses are looking for ways to adjust to the economic changes it has caused. Some firms are considering early retirement packages or voluntary layoffs. If you're nearing retirement, these options may seem attractive, but what are the possible pitfalls? We at Vestry know how confusing these life-altering decisions can be. After all, Tom and I have been helping you manage your financial life for more than 30 years each. That's why we're offering a free virtual meeting with one of Vestry's 100% fiduciary advisors with no obligation and no sales pitch ever. If you need help, set up your appointment today at talkingrealmoney.com/meet. Let us help you better understand your options and create the plan you need for the best possible retirement, absolutely free and from the comfort and safety of your home via Zoom or phone. Set up your appointment now at talkingrealmoney.com/meet. That's talkingrealmoney.com/meet.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
You need some help with your money? We want to provide it at 855-935-TALK, 855-935-8255. You can call that number 24/7, too, and leave your question for answering on the podcast.
And before we continue, with Suzanne, if I can just say thank you to Mark, who just emailed me an article about Seattle's pension fund compared to the state of Washington pension fund. So I'll take a look at that and maybe chat about it next week. So thank you for doing that.
Follow up on that, huh?
Mm-hmm.
All right.
Good stuff.
All right. We've got Suzanne on the line. Suzanne has got an IRA and I assume, regular investment account.
Post-tax account, yes.
Post-tax, yeah. And Suzanne, you said you think you might have made a mistake. What kind of mistake do you think you made?
I don't know if I did or not. Okay, we go back to almost the Big Depression as to my husband's and I longevity of life. And so we came up during a period of time, and which was a little difficult. We were very well aware of the dangers involved in losing money.
Yes,
and
ma'am.
now again, more people, I think, out there are aware of it. So what's happened is
let's talk a little bit, rather because of the limitations of time.
Yes.
What kind of investments do you have in your portfolios, in your IRA and your regular account? What kind of
All
things?
right, mainly we've done government, a lot of government bond type of things, treasuries, Ginnie Maes, that kind of thing. We started branching out by doing balanced index funds. We have money market funds. We have like some a life strategy conservative growth fund.
Sure.
And we've got an energy fund. And
are you getting
we have
guidance
inflation
on
protected securities
Yes,
and a
tips.
Wellington?
Yeah.
Okay, so it sounds like you got a lot of Vanguard stuff.
Yes, everything.
Are you doing that on your own, or are you getting advice from someone?
Yes. No, we've done it all
Okay.
on our own.
The only thing I heard that I found to be possibly a mistake is when you try to bet on an industry. When you buy an energy fund, that's a bet on an industry.
I'll add one more mistake, by the way, because I think it's where the conversation started.
Sure.
There's a reason to own certain types of securities and certain types of accounts, because you mentioned an IRA, which is where money has gone in before any tax has been paid, and when money comes out, you have to pay tax on it at regular income tax rates, versus a regular post-tax type of, as you said, investment account. We would call that a taxable account. There's certain things you should own in your IRA that you should not own in your taxable account, because you mentioned TIPS, for example, Treasury inflation protected securities.
Yes.
Those are very tax inefficient. Those should be held in an IRA. For the most part, bonds make more sense in an IRA, unless they're municipal bonds, because you're going to end up paying tax on the interest in a post-tax account. So, but that's, is that the kind of question you're asking? I mean, those are the kind of things that there are reasons to look at that for reasons of taxation.
Right, exactly. Thank you. Uh-huh.
So does that help?
Yes.
Or not?
Or do you want to go back to people losing money? We can talk about that too. So, no,
The
kidding.
only other one
You're
that
doing
would-
okay.
You're doing fine.
Yes, that would fit within, besides the, another sector, say, account would be, we've got the healthcare
Yeah,
fund
and
also.
we're gonna. Don mentioned this a couple minutes ago. Healthcare, energy, technology, commodities, whatever. Those are really, for lack of better expression, bets on, that's a great sector because healthcare, because everybody's getting older. People are going to need more healthcare. Or energy, because the United States is becoming energy independent. How's that working for you in 2020? I mean, all those things are sort of bets. We believe in a widely diversified portfolio that holds all of those industries, if you will. Most countries, too, like 100 and something countries. That's what we believe, and you take advantage of the growth of sort of global capitalism. That's the way we would suggest you invest. But it sounds like you've done a great job to me, Suzanne. You got a lot of different assets you're holding there. You're thinking about these things, and you're using Vanguard, which is a fund family that we really respect.
So you're doing great.
At this point, do you think, though, that we should be reducing some of the money in the sectors and then picking up?
Our opinion is you should just get out of the sectors altogether.
Yeah, I mean,
you've got
maybe
life
stocks?
strategy funds, and just move that money from there into your life strategy funds,
which are relatively diversified, which aren't trying to make bets. They're simply holding a wide basket of securities generally.
Gets a lot of dividends that I have to pay on.
Yeah, but
I mean,
it's
as
better
soon
to
as
have.
I see I got to outlay money, I freak out.
I know. Everybody does, because for some reason, we get it in our heads that it's better to that it's better to not make anything than to pay taxes on money we're making. It's okay to pay taxes if you're making money. I'd rather be making money and paying taxes than the opposite.
But that goes back to what I just mentioned, too, by the way. There's a reason, if you have to hold things like that, that should be held in your IRA, because you don't have to pay tax on that money until you take it out. Whereas if you have that in a taxable account, and those are taxable type events, the issuing of dividends, interest, that kind of thing, then it does not make sense to hold that in a post-tax taxable type of account.
And as you said, as an old timer, it may be time to simplify. And there's no benefit to having the healthcare fund or that energy fund other than to speculate on those industries. And do you know for a fact that they're both going to go up in the near future? If you don't, then you're, in our opinion, and it's a pretty strong opinion based on science, you really should just stick with a diversified portfolio that will own energy anyway, that will own healthcare anyway. Simplify your life and reduce your risk, because owning those segments of the market, you could make a lot of money. Yeah, you could also lose a lot, as you have in the energy sector. So don't try to time the market and say, well, I'm going to wait till it goes back up.
Yeah.
Just do it.
Good luck to you, Suzanne, and thank you for your call, and thank you for listening to the program.
Well, we're not done yet, are we?
No, well, I meant like.
Oh, you think you meant Suzanne? I thought I didn't know if it was just a general.
Well, maybe I'm giving you career advice. Thank you, Don, for being part of the program.
Thank you for being, and I'm done now.
I'm sorry, that was too easy.
As if COVID wasn't bad enough and changed the world enough. It's pretty
exactly
miserable. Anyway, so here's the deal.
Yes.
If you have questions for us, we are around all the time. We don't just do this show on Saturdays.
Do you want to tell them about the other thing we're adding? Or
no,
not?
Because we're not adding it yet.
Okay.
No.
I'm always jumping the gun on stuff like
You're
that.
You're way ahead of the game. I'm busy. I'm rebuilding the Vestry website.
You are.
And boy, is it going to be lovely.
I saw the scaffolding that went up to work on that. Congrats. It's huge. Huge.
Oh, well, you wait until I do the ceiling. I have to lay on my back.
And start painting with those little brushes and stuff?
With the little brushes on my back for like 6 weeks on my back.
Just hurting my muscles thinking about it,
I feel like
man.
Michelangelo. 855-935-TALK. 855-935-8255 is our phone number. You can call that anytime, 24/7.
Tom and Don are talking real money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times.
Also, as much as you want it, no one can accurately, consistently predict the future.
So past performance doesn't tell you a darn thing about what the future will bring.
Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities.
Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor.
Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures.
That's a wrap.